Ho, ho, ho. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. We are live. Today is Tuesday, the 27th of December. Only a few days left in this year, folks. I'm very excited for the new year. I'm your host, JD Durkin. Opening bell rung here on the floor a moment ago by Little Saint Nick Foundation. Let's take a look at how the major averages are kicking off this Tuesday. The Dow was up fractionally in the first minute or so of the trading session. The S&P down fractionally in the red. We'll get a better sense of what investors have in store for this trading Tuesday in the next few minutes after a long holiday weekend. The Street kicking off the final trading week of the year. The stocks look to notch their worst annual performance since 2008. Not that they want to, they just very well may. Taking a look at what is on tap for this morning's broadcast on this Tuesday. We'll talk market expectations as stocks look ahead to the new year. Plus, we'll discuss reopening news out of China as that nation eases some of its strict COVID policies, welcomed news by many. And finally, we'll give you a picture of retail as holiday sales soar past expectations. And for more on those stories and so much more, we now welcome in our chief Christmas correspondent. He also goes by other things like the Action Alerts Plus co-portfolio manager, Mr. Chris Versace. Chris, good morning to you, my friend. I almost said happy Christmas, Merry Christmas, Happy Christmas, whatever you want to do. Fill in the blank with your holiday wish of choice.
If you're in the UK, and I know you're usually talking to Martin, it's Happy Christmas.
Right, fair enough, fair enough. I guess I learned a lot of UK lingo from Martin over the course of doing the show. I've gotten a really good education here this year. But while you and I have the opportunity to share the airwaves, not just today, but for the next few days here for the market open, let's talk about markets. Coming off a long holiday weekend here, Chris, give me your sense what's top of mind for you and maybe for many investors out there during this shortened holiday week.
Well, it's a short week. It also is typically a very quiet one. We don't have a lot of earnings. There's not a lot of economic data, coming. And people are looking for this mythical Santa Claus rally, a nice strong finish to the end of the year and start of the coming one. But I have to be honest with you, there's a lot of, data out there that just has me concerned about, 2023, particularly the first half of the year. And I think that we could see some companies start to give us some news that says, what earnings expectations for 2023 may not be that robust. We've gotten a lot of data in December that points to concerns about the strength of the economy, whether it was the ISM PMI data, the S&P Global PMI data, and even this morning, while MasterCard came out with some good numbers for the holiday season, Target came out and said, hey, guess what? We are going to do some steep discounting because guess what? We have too much inventory. And I think all of this is going to bubble up as we move past the end of this week and into next week, to be honest with you, JD. So I think enjoy the holiday week if we get some lift, but I don't think we're out of the woods quite yet.
What is most concerning with you with regards to potential data points to kick off 2023? You were alluding to those a moment there, Chris. I wonder what's top of mind and perhaps on your horizon that you think investors should be closely paying attention to?
So I'll give you two things. The first is going to be next week when we're back after the New Year's holiday. Remember, the market's shut next Monday. It's going to be what does the latest ISM data and the S&P Global data for December have to say. There's a close correlation between the S&P Global data and that ISM data with S&P 500 revenue. So to set the stage, the data has been weakening. S&P Global data showing actual contraction in the manufacturing and services economy. The ISM data a little stronger on the services side, but weakening on the manufacturing side. And again, there's a very, very strong correlation with those data sets and S&P 500 revenue. So as those numbers weaken for the PMI data, we should start to see S&P 500 revenue data come down. In a sense, it's going to reignite the concerns about expectations for revenue and earnings amid a slowing economy with concerns for a potential recession, perhaps sometime in the first half of 2023. So the second point is S&P 500 earnings expectations. Now, over the last few weeks, they've been still positive for 2023, coming in around 231, 232. That's up from about $220 for this year. However, as we get more data, the concern I have is we're going to see those 232 numbers for next year, the consensus number, start to come down. And indeed, we've been chatting with this with AAP members that that's a big risk given the economic data, but it's also a risk for what's likely to happen to the market in the first half of the year. Now, are we starting to see some folks do that and bring down their 2023 earnings expectations? We are. Some as low as 195. And again, the context here is 220 this year, 195 next year. So I think as we move past the holiday week, we start to get that data I talked about, and we get ready for the December quarter earnings season, we're going to start to see more downward revisions for those 2023 earnings expectations for the S&P 500. The crux of the question, JD, will be this. Is the consensus moving towards a flat number year over year, or is it more likely to be down? If it is down, then we have to think about the market multiple and what that means. So the concern I have is downside ahead.
3826 is where the S&P sits as we are currently having this conversation. People are saying today's supposed to be the second day of a potential Santa Claus rally, if I'm not mistaken. This will extend until Wednesday of next week, given that Monday is a day off. Where are we in terms of the search for another visit from Santa Claus?
I think we have our binoculars out. We're trying to see, as you pointed out, we're only 2 days in and we have several days to go. So, we have to take the rally in totality. Again, my concern is that, there might be a little opium this year for the end of the year rally. I'm not convinced that we're going to get it. I think that even if we do get it, as people, come back from this week off, again, a very quiet one, and they roll up their sleeves, sharpen their pencils for the coming year, they're going to do the math that I was just alluding to and think about, where the Fed funds rate, when it was last around 5%, that was around 2005, 2006. The market peaked 17.3 times or so, average between the 2 years. That's where the market closed last Friday, JD, 17.4 times. So as people think about this, while we might be hoping for the Santa Claus rally, my concern is Santa might bring them some coal for the start of the year.
We talk a lot about the era of easy money being over, and I think it's easy to look at the last couple of years since the start of the COVID pandemic, early 2020. But you bring up a great point there to say this era has really gone back the last 14 years or so. Is there anything about this story of now having higher rates for longer through the bigger picture lens that you think we don't talk enough about? Yeah, we talk about the last 2 years and the difference between 2020 rates versus rates now, but really this goes back more than a decade. And I wonder, as you hear, and you're very tapped into all these conversations, Chris, is there anything that you would want people to keep in mind that you think oftentimes kind of gets missed as we talk about these business headlines and what the federal funds rate actually means? Because, like you said, it's been some time since we've been around 4 or 5%, right?
Yeah, so the knee-jerk reaction is, higher borrowing costs, both for businesses and consumers. But I think sometimes what gets lost in translation is that for those risk-averse investors, there's actually a natural alternative now, right? Higher savings rates. So, they can sit around, afford to be patient, right? There isn't that, what's called, TINA, there is no alternative, right? Because interest rates are next to zero, right? So what am I getting in my savings account, my money market account? Next to nothing. I might as well take those funds and put them into the market. That's helped drive the market higher over the last, as you pointed out, decade or so. So without that alternative, or as we say, a new alternative, a fresh alternative that I can afford to sit out concerns of a economic recession, earn, some modest amount of my money, better than perhaps people fearing losing it in the market, that could take some of the inflows out of the market that's helped power it higher over the last decade.
Yeah, of course, especially if you have a high yield savings account. Thank you for highlighting that it's not necessarily all doom and gloom. And you hear the experts who say if you don't have a rainy day fund, this is about as good a time as ever to consider building one up. I do want to ask you about geopolitical pressures. It's something that I know you cover closely. Undoubtedly, the top stories have been China and Russia's war in Ukraine. But I wonder what developments we've seen on those fronts and what they could mean for investors here at home.
So, both have been going on for some time, particularly the Russia-Ukraine war. The big question I think everybody is wrestling with is, when might it end? We are heading into the winter months there. It's expected to be rather challenging situation for both sides. And, there's some chatter over the weekend that Vladimir Putin is saying, hey, Russia is ready to negotiate with the Ukraine officials saying he's not serious. This is not going anywhere. And I believe there's some reports out too over the weekend from the CIA and the FBI and other institutions in Washington that there is no real intent by Putin to negotiate. This is more lip service. So I think we're going to have some back and forth on this. I think we just need to continue to brace for it being, much like the Fed, going longer than probably originally expected. The other side of it, though, is China, Taiwan. China citing some activity between the U.S. and Taiwan over the last couple of days. My understanding is there were some fighter jets buzzing the area, renewing some concerns there. I think one of the biggest issues with 2022 was this geopolitical uncertainty. And unfortunately, as we look to put 2022 to bed in the next couple of days, it tells us that that uncertainty is going to remain with us as we head into 2023. The only positive news that I can possibly see here on the China front is they continue to loosen restrictions. I just think we need to get through this N wave of cases, perhaps sometime January, February, before they truly open up and things are back to I won't say the races in that economy, but better than they have been.
Yeah, of course, and especially when you talk about Russia's unjust war in Ukraine, first and foremost, it is a deeply human story, and the most important part of that story are the vulnerable communities who continue to be at risk. Secondarily, past that, it is also a story of economic importance, and that is the lens with which we cover it. Just every time we cover it, I want to make sure that we're doing our due diligence to highlight the part of the story that is objectively most important, while also keeping in mind there is specifically an impact on energy prices, food prices that are being felt throughout Europe and, of course, throughout the world as well. I do want to ask you about China, that country now beginning to ease its zero COVID policy, another story of great business importance to investors here at home, Chris. And that's been developing overseas really this last week or so. What's the latest there from the globe's second largest economy?
Well, it is that they are going to start to ease restrictions even further. I believe the latest is on travelers, and that's going to start sometime early in the new year. That'll be a positive for that economy. But we are also hearing about the impact of this N wave that I just alluded to. EV company NIO cutting its outlook for deliveries in the current quarter. They said they were going to do 43,000 to 45,000, I believe, and they're trimming that back by some mid-teens percentage because of this latest round of COVID cases, as well as ongoing supply chain issues. And I doubt it's going to be the only company that's impacted by that. There's been some concern over the last several weeks about iPhone production issues, again, stemming from this N wave of COVID cases. And I think we're going to see more of that. The dichotomy here is that consumers are out, right? They're shopping, traffic is rising in the major cities in China as they finally get to go out and consume, which is great for consumer-facing companies. But on the production side, there still seem to be some issues. Again, as I said earlier, I don't think we're quite out of the woods yet, but I think it points to perhaps a stronger first half 2023 than second half 2022 for China. That's actually somewhat positive note.
How are ongoing lockdowns there specifically impacting automakers? We talk a lot about Tesla and the Shanghai factory, but that's an enormously important space and an intersection of stories to keep an eye on, right?
100%. And it's when we talk about EVs, a lot of people tend to talk about Tesla, but there are a number of Chinese EV companies in there, everything from NIO to XPeng to Bird, and it's not just autos, right? There are buses, there are bikes, there's other, other personal vehicles, let's just call them, as well as the developing industry that I think a lot of folks are watching, which is the actual trucking industry for EVs. So there is a lot going on there. What's interesting, though, is if we compare, contrast what Toyota had to say with what NIO did. So as we just talked about, NIO and even Tesla, they're clearly having issues. I think Tesla said that they're going to shut down their Model Y production between Christmas and New Year's in China. There's also some chatter there about some greater discounts as well to help move the products that they do have. Again, NIO cutting production given this end wave. But Toyota came out and said, hey, guess what? Overall end demand for us, simply fantastic. We shipped more than we expected to. However, they too warned that there could be some demand side issues as we start out 2023. So I think the auto space is kind of a challenging one, kind of a yin and the yang here, JD, between demand and supply. If supply gets better, and by that I mean the ability of companies to produce more, that's great. I think as we head into 2023, though, the bigger question is going to be, what is the demand profile? Remember, if we have a recession, odds are people are not ponying up to buy new cars as quickly as they would have been, in 2022, 2021, or previously. However, in the US, we have to also consider that there is this EV tax credit that's coming into play starting in January. Now, that could help spark demand for EVs here in this country. So that's something that we at the AAP portfolio are going to continue to watch. Could help make those vehicles a little more cost affordable during a tough time.
Separately, this wasn't something I had planned necessarily to ask you about, but to the point about Tesla, is there any sense from the numbers, and maybe it's just too early, that consumers who have long thought that Tesla is the undisputed leader in EVs and that's the way to go, and if you're going to get an EV car, you got to go Tesla, have now been shaken in their consciousness to say, this guy, I don't know. I'm not a big fan of the tweets, not a big fan of how he's conducting himself personally with regards to business. Maybe there are other options. Maybe I do look at a Ford. Is there any sense of a bit of loss of market share for Tesla because perhaps of the antics? That's just one of many words I could use to describe it, but the antics of an Elon Musk? I'm being polite here on the show, all right? It's the holidays.
Is it possible? It is certainly possible. It's very hard to quantify, right? Just because someone appears to go off the rails, hard to say. Hard to put the numbers behind that. But you raise a good point, right? For the longest time, Tesla has been the shining star in the EV space, arguably, the lone player by a number of folks. But what do we know? We know that whenever a market starts to explode, other companies are going to gravitate towards it. We've seen this, I can't even tell you how many times in the consumer electronics space, and it is happening here in the auto space. And you raise a good point, and it's not just Ford. Pretty much any automotive manufacturer is leaning into the EV space, up from luxury cars all the way down to entry-level cars. And we've probably seen even more car companies trying to tackle this as they focus specifically on this opportunity. And again, it's not just autos, but it's also trucks as well. So the question I think that investors have to, kind of puzzle through is, can Tesla remain the only player in this space? And the answer is, of course not, right? It is by nature of new entrants going to lose market share over time. But here's the interesting thing. If you look back along the consumer electronics market, there tends to be a new wave, a lot of entrants, and then the market over time tends to consolidate around somewhere between 3 and 5 players that have the lion's share of the market. And I wouldn't be surprised if we see this happening again. The question that I'm not sure about is this overall, or because the automotive market is, kind of a, I'm trying to think of a word here. It's a market that has different end markets. I know it's a little confusing because you have trucks, you have sports cars, right? You have SUVs, and you have other entry-level vehicles, right? And there's also more commercial trucks. So we could see certain players become very strong in different markets. But by and large, I think, in the next 3 to 5 years, we'll be talking probably more about 3 to 5 key players in the overall consumer automotive market.
Absolutely. I do want to ask you about a new MasterCard report that I know you are well read in on. It saw retail sales growing 7.6% year over year, stronger than expectations. Chris, what more do we learn?
Well, when we break these numbers down, we always want to try and understand 2 things, right? Where is the strength in the report between in-person and online? Once again, online continue to be stronger than that overall number. Great if you own shares of Amazon and other companies leaning into online commerce. Also good for companies like UPS and FedEx because when you order it, it's got to get to where it's going, whether it's to you, a loved one, or someone else during the holiday season. So those are good data points. In-store was actually less than that 7.1%, I believe mid sixes. But when we dig into it, what was really interesting to me is that restaurants continue to be extremely strong, up more than 15%. So more than double what people were already spending in general for the holiday shopping season, telling us people continue to eat out no matter what. And I think that's going to be really good for a number of different companies, particularly those that are more in the fast casual quick service space. Think Chipotle, think McDonald's as people are out doing their shopping. We have seen data that said people are eschewing fine dining and casual dining because the prices continue to move higher, as we've seen in all the CPI reports of the last few months. The other area that I would highlight would be the quote losers, if you will. Electronics down year over year, according to MasterCard. Same with jewelry. So maybe not so good if you're Best Buy or Signet Jewelers.
To that last point, what's your go-to order from Chipotle?
Oh, well, the first question always,
Yeah.
and I teased Catherine Ross this when we did our last AAP members call for December. First question, burrito or bowl? That's always the first question. Here's my answer. If they have the steamed cauliflower rice, it's always going to be a bowl. However,
wow,
if they don't have it, I will go for whatever the new item is du jour, a little bit of brown rice, a little bit of vegetables, maybe probably some beans, medium hot sauce, guac, lettuce, and corn.
Solid, very
That's
solid. I didn't.
And to be clear, sorry to cut you off, JD, that my burritos are big, so much so that they tend to rip. So at some point, I'm going to wind up sending an email over to the Chipotle guys saying, look, you guys got to do something about this.
I'm sure they're watching the show this morning. So to Mr. Chipotle and the team, I hope you can take that into consideration. But also, that's how you know it's a good burrito, right? When it's busting through the seams, that's what you want. That's what you want to go. If you're going to pay that kind of dollar for those prices, you want to get your money's worth. That's a solid answer, by the way. And again, not the most important thing I'm going to ask you this morning, but a fun one regardless.
Well,
okay, let's move on here. Well, yeah, go ahead.
What you didn't ask me is how do I overcome that post-burrito afternoon food coma nap?
I just assumed you'd take a nap, but I don't know. Maybe you drink
coffee.
No.
I can't do that. We have too much to do for the AAP members during the day. I can't afford to do that. It's usually this is a little secret here. Usually I will swing by afterwards and get a double espresso con pana from Starbucks.
Wow, listen, another top name. And see, this is an important conversation because people are saying, what are these two talking about? Who cares? But this is anecdotal reporting about how an American consumer spends his money and the places that he goes to prioritize to keep his day going. That's what we're all about here on the show, having you better understand how consumers are spending their money, especially in a holiday season.
But you got to go.
Yeah.
You got to go con pana. For those who don't know, it's real simple. Whipped cream. Who doesn't love whipped cream?
Sure. Yeah, we absolutely do. We all do. Okay, are you ready for our rapid fire section? That's how you know we're towards the fun part of the show because we're near the end. Okay, I do want to ask you about air travel because people are waking up to see lots of headlines and none of them are good specifically for Southwest, but we did have increased air travel, not just good for the airlines, but what's the sleeper company that could also see a huge bump, Chris?
Yeah, so if you look at the TSA data, it's up about 14% year over year, quarter to date. There's been a lot of surveys from Hopper and other companies saying that Americans are looking to travel abroad, taking advantage of the dollar's strength. The company that I like amid all this is the company that helps you cut through those lines, whether they're regular TSA lines or even pre-check line, TSA pre-check lines. That is Clear Secure. And they've been adding the number of airport partners as well as airline partners. And I think that company, I got to tell you, I was traveling, as you know, to Puerto Rico and back, JD, during last week. And I will just say this, more people signing up for Clear And I've heard anecdotal evidence from my partner, Bob Lang at AAP, that he saw that as well in the last few weeks in his travel as well. So much so that we actually added to Clear Secure today for the AAP portfolio.
Okay, all right. That is something that we've talked a lot about. Oftentimes you've got lines for at least TSA pre-check that are longer than the non-pre-check lines, but that was a different conversation for a different day.
Did I tell you, do you have time for a quick story here?
Very quick if we can, because we are running out of time, but go ahead.
Okay, so the last time I had to travel, I went from the car at Dulles Airport, closed the door, walked underneath the big tunnel system, was through security because of Clear and TSA pre, 7 minutes. That's the value.
That is the value. I am sorry you had to fly out of Dulles, though, which is the worst airport I've ever flown out, having lived in D.C. for many years. Sorry, Dulles folks. All right, let me ask you about MasterCard, that company, like we talked about a bit ago, finding more than 7% increase in holiday shopping. Good news for UPS and FedEx? What are your thoughts?
I think that is 100% true. If I had to choose one for watchers to buy into UPS or FedEx, that would be UPS. Its business tends to skew even more so than FedEx into that home delivery service that we all love during the holiday season.
All right, third and final. Do you expect to see any slowdown in cyber attacks in 2023? Wow, what an important conversation.
No, 100% no. I think what we've seen from the success from the cyber attackers' perspective in ransomware, I think that's going to continue to happen. I do expect identity in particular to be a very big topic in 2023, along with privacy. And if you think about it, that brings me back to my recommendation a few minutes ago for the shares of Clear Secure, ticker symbol YOU.
All right, that's our chief burrito and double espresso correspondent, Chris Versace, also co-manager of our AAP portfolio. Chris, thanks a lot, man. We get to do this for a few more days this week. I'm looking forward to it, and I'll catch you tomorrow.
As am I. Hopefully I'll have a new food order to share with you.
I am looking forward to it. Chris, thanks a lot, man. That's going to do it, folks, for the market open here from the floor of the New York Stock Exchange. Stick with the street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.